Hello, I'm Irina Ryshkova, your nonprofit auditor. Welcome to our next NAP. NAP stands for Nonprofit Auditor Points. And here we discuss issues and topics related to accounting and finance. I design NAPs specifically to help nonprofit community to better understand how auditors work and analyze some accounting and finance topics. Full disclaimer, these are not authoritative videos. These videos just me sharing my experience over many years and knowledge that I received by working with nonprofit and being nonprofit auditors. So if you have any specific questions, if your organization has any issues that needs have some complicated dive, you need to consult with your own auditor, with your own finance team. Let's start our NAP discussion for this time. It's going to be main financial statements for nonprofits. As always, we're going to talk about based on GAAP, General Accepted Accounting Principles in the United States. If your organization need to issue full set of financial statements, it means that your financial statements need include 4 main financial statements for nonprofit organizations. One first financial statement is statement of financial position. It's very similar to balance sheet for for-profit companies. The second statement is statement of activities, similar statement of profit and loss statement or income statement for for-profit. Third statement, it's unique for nonprofits only. It's a statement of functional expenses. And last statement, statement of cash flows. So 4 statements: balance sheet or statement of financial position, income statement or statement of activities, statement of functional expenses, and cash flow. All these 4 statements have different purpose, and they provide comprehensive view of the organization performance. They all need for the full understanding of the organization analysis. So let's briefly discuss what main purpose for these 4 statements, and we will dive in deeper in analysis of each statement in our following apps. So the first statement of financial position. In nonprofits, it's called balance sheet. And this name says that the balance sheet has to balance. The balance sheet has 2 parts: assets and liability and net assets. Net assets is similar to equity, and these 2 parts always have to equal. Balance sheet or statement of financial position shows the position of the organization at specific point of time. It's like a snapshot. It's like a picture. You take a picture of the organization and you can see everything that the organization has at that moment and everything that the organization owes to outside parties at that moment. It's very important statement to understand liquidity and structure of the asset and liability of the organization. Probably the main point what readers of financial information are looking in the balance sheet, it's liquidity. Liquidity if it means that the organization has more liquid assets such as cash, investments, than current liability. Why is that? Because it indicates the ability of the organization to pay its current liability. If the organization has more liability than current assets, it means that the organization might not be able to pay its debt and might face issue of going concern or liquidity. Second statement of activities, or profit and loss statement or income statement. These names are used interchangeably. This is one of the probably widely used statements that everyone is using, including management, including operating team and admin team, because profit and loss statement shows the organization activity for a specific period of time. It can be a year, can be months, can be quarter, and this statement is great to compare with previous periods or compare against the budget. That's what typically budget is used for, to prepare the expectation for the next year profit and loss statement. And that expectation, which is budget, gets compared with the actual profit and loss statement for the period. Profit and loss statement is very important because it shows how much money or income organization earned or received support, and what were expenses. So bottom line, which is change in net assets or net income, even though that's not a proper form terms for nonprofits because there is no profit, but bottom line, that overall revenue or support that organization received should be more than expenses. We typically would like to see positive net change in net assets. Pretty typically you want to see net profit rather than net loss. So that's where the main focus of the readers of financial statements go when they analyzing profit and loss statement. And definitely profit and loss statement provides a great analysis of revenue breakdown for nonprofits, where nonprofits derives its revenue from government grants, from fee for services, for special events, for in-kinds, and so forth. And it also provides a good breakdown of expenses, where the organization spended expenses, what type of expenses, such as payroll, depreciation, benefits, consulting fee, etc., etc. Third statement, statement of functional expenses. Statement is functional expenses. It's unique statement specifically developed for nonprofits that shows effectiveness and efficiency of nonprofit by indicating where the effort of nonprofit is put, whether it's directly to the program or maybe it's to admin and management, and or maybe to fundraising. The statement splits all these expenses to three buckets: program, management in general, and fundraising. And a lot of rating agencies use this statement to see how much direct program activity how much expenses go to direct program activities, because they prefer to see main amount of dollars spending for main mission of the organization, program activity. It's a very useful statement. It provides a lot of information about organization efforts and allocation methodology of overall expenses. And the last statement is cash flow statement. That statement is very often is neglected and not understood. However, that statement provides a very valuable information. As you know, general accepted accounting principles use accrual method of accounting. It's not just flow of cash, it's accrual, meaning we accrue some expenses or revenue for which cash we did not receive, nonprofit did not receive. Therefore, we have receivable, which means revenue was earned but the cash was not received, and we have a payables where the liability was incurred but the expenses were not paid yet. Statement of cash flow recalculates accrual net income back to the cash inflow or outflow, and indicates cash inflow or outflow for the period for three different sections: operating activity, investing activity, and financing activity. As a reader of financial statements, we prefer to see positive cash inflow from operating activity, because this is the main purpose of the existing of nonprofit, to derive its cash inflow from operating activity. Investing and financing activity, it's peripheral to the overall existence of nonprofit, and even if it was a cash inflow from that parts of the organization, it's not always means sustainability and good performance of the organization. Again, there needs to be done a deeper analysis of all these four financial statements, and if you analyze all these four statements, they will tell you the picture, where the organization stands, what was its performance for the period, and why. What if you just look in one of the statements, you will not receive a full picture and presentation of understanding of nonprofit performance, its financial position, and its flow of cash, its liquidity, and possibly sustainability. To conclude, I would highly recommend management team, finance team, take a look periodically, not only on its profit and loss statement, but have a full set of financial statement and to see how your organization look from the overall picture, because only four statements will be able to provide you that picture. I'm looking forward to see you for the next snap. In the next snap, we will dive deeper to analyze balance sheet or statement of financial position. Thank you for being here with me. Have a wonderful day.